Hello, everyone. This would be a great time to kind of have everyone turn your seats around so you can face the front. Today we have Burt White. He's the executive chief investment officer at LPL Financial. The research team now consists of over 50 individuals that he oversees. I'm not going to go on and on with all the details of Burt. A lot of you have seen him on CNBC and Fox and News and in a presentation, one fashion or another. So he's going to be here afterwards if you want to answer some questions or talk to him about politics. You'd love... No politics today. Anyway, I'm going to bring up Burt White.
Thanks, Joe. And by the way, that was a great intro. It was exactly the way I wrote it. Thank you. It's great. Hey, everybody, how are you? Yeah? Was dinner good? It looked like really good. I'm not going to lie. So here's what we're going to talk about today. We're going to try to find this guy, right? I mean, where's the bull been? You know, the market hasn't hit an all-time high for 270 days and counting. We've gotten close a few times, but we haven't quite got past that. It's been over a year since we've seen an all-time high. In fact, if you go all the way back to really October, November 2004, we were about at these levels. And so where is the bull? And that's what we're going to try to talk about today. Where's the bull, and is the bull coming back? Now, what's important to know, and I'm going to just give you the spoiler alert right now, okay? So that if you just want to tune out the rest of the time, you can. Just give you the spoiler alert here. See, the bull's on a pause, but it's not the end of the bull market. Now, I know those sound similar, like sort of a missing bull kind of feels like the end of the bull market. But they're two very different things. For example, the word exercise sounds a lot like the phrase extra fries. But they're two very different things, right? The same is true with this bull market. The fact that the bull market is missing, it's paused a little bit, sounds like it's over. But I think what we're going to find out is that it's not over. And we're going to try to build that for you today. Now, what's important to know is where we've come and where we are. Now, as a presenter, I'm left-handed, so I'm going to be on this side of most of the time, if that's okay. So my apologies over there. I'll try to get over there. I'm actually right-handed, but as a presenter, I'm left-handed. So I'm always at the left-hand side of the stage. I don't know why. It's just a bias I have, okay? What we're looking at here is consumer confidence. And what's important to know is that consumer confidence around 100 is average. And you could see where we were in 2009. That was the depths of the Great Recession. And you could see we were nowhere close to 100. Our confidence was not very high. It wasn't very high about where we were in the present, and it certainly wasn't very high about where the future expectations were. But as we got to 2014, the Federal Reserve has already been keeping interest rates at zero. They've done quantitative easing 1, quantitative easing 2. They did quantitative easing 3. They just ended that in 2014. And you could see where confidence had risen. It had almost doubled from the depths at what we weren't past 100 yet. But we were getting better. But what's fascinating is to see where we are today. The present, how we feel confident about today, is pretty good. In fact, it's about as good as it ever gets. About 116, that's about as high as it gets. We might get to 120, maybe 122, but we don't get much higher than that ever. But look at the future. We're not very confident right now about that. In fact, we're at the same level, if not lower expectations than we were 2 years ago. Things are pretty good today, but I'm worried about tomorrow. And you're seeing this a lot. In fact, Gallup does a great poll. It's the percentage of Americans that own stocks. And we know how important having a diversified portfolio and making sure that we think about equities as a component piece of it if it makes sense for you and your plan. But look at the number of Americans. It topped out in 2007, and then 2008 and 2009 were so hurtful that now we are at multi-generational lows of Americans that own stocks. You're starting to put these things together. It's a lack of confidence is what we feel. I would argue we are in a recession right now, but not an economic one. We are in a confidence recession. We don't have any. We're not confident about anything. I don't think we're confident about what's going to happen in November with the election. I don't think we're confident with the economy. I don't think we're confident with anything. And I think we're nervous about that. And that is what's kept the bull hidden. But what I want to do is I want to dispel a couple of the more common suspects that often kidnap the bull. Because the bull's been kidnapped before. I mean, he's been around and then he's gone, and we saw that in 2008 and 9. That wasn't fun. And we saw that in 2000 and 2001 for that recession, and that wasn't fun. We saw it at 94. We saw it at 90. We saw it in 87. So we've seen the bull disappear before, and we know the most common villains. By far the most common villain is this guy. We call him Mr. Excesses because he's excessive in every way. And it's usually excesses that bring down the bull market. You see, what usually ends a bull market is that things get pretty good. And we begin to overspend, and we overhire, and we overbuild, and we put too much money on our credit cards, and we extend ourselves too far, and things get so good that, frankly, we get too much of excess. And then once we get too much of an excess, it resets. Think about what happened in 2007. You know, from 2000 to 2007, people were saying, I don't need investments. I need a real estate agent and buy a couple of extra homes. Everyone had 3 homes in 2007. And then 2008 and 9 came. And that reset a whole lot. Put things into perspective. We got out of balance. We had too many excesses. Here's an interesting component. If you look at each of these are recessions. These are all the recessions that began. I'm going back to the 60s. What's really interesting is the number beside it. That's the number of times that the Fed raised interest rates following that recession. Now think about this now. In 1960, in the third quarter, we started a recession. And then the economy got worse. What did the Fed do? It lowered interest rates. It spurred the economy. And then things got better again. And as things got better again, what did they start doing? Raising interest rates. And they ended up raising interest rates 15 times before the next recession in 1970. See how that works? Then in 1970, we had another recession. And then it got bad, and they lowered rates. And then what did they do? They started raising rates again. And that time, they raised them 10 times before the next recession in 2014. And you could see how many times the Fed ended up raising rates. Now, why does the Fed raise interest rates? Why do they do it? To slow the economy. Why on God's green earth would they want to slow our economy down? To avoid a recession. Now, that's the irony, is that it usually causes one. But what they're really trying to do is to normalize the excesses. We start overspending and are overhiring and overborrowing, and things get crazy. Heck, if interest rates stayed at 0 in 2007, we wouldn't have each had 3 homes. We would have had like 9 homes. They had to raise rates to make it so we wouldn't buy everything up. But here's the interesting point. On average, the Fed has to raise rates 18 times. At the minimum, 10. We've never seen a recession where they didn't raise rates at least 10 times beforehand, and on average 18. How many times have they raised rates this time? Well, once. And it was regretted once. They kind of wish they didn't do it. Right? So here's your greatest proof point that we're not at the end, or at least this suspect has not kidnapped our bull. We got a ways to go. Until the Fed normalizes interest rates, we ain't recovered yet. We got a ways. That's why we think this bull market's got some legs to it. It's missing, but we've got some legs. Another great way to look at this is something that we watch a lot. It doesn't get a lot of press. It's one of my favorite things to look at. And it's something called the U.S. output gap. And let me tell you what it is simply. It's the difference between potential GDP and actual GDP. So let me tell you what that is. GDP is our economy. It's all of our goods and services, add up everything that happens in the year. Every vacation we send, every car we buy, every bloomin' onion we get, every trip to Walmart, everything. Add it all up, that's our economy. That's GDP. But what we also capture is something called potential GDP. It is, what can our economy really achieve at consistent interest rates? What's our potential? And that's that line at 0. What I've done with these little dots is those are all the periods of time that you saw a peak in potential GDP. And what do you note? See all these lines going down? Every one of those lines going down is a recession. And notice, before every single line, you saw what? Potential GDP up in the green. It means we were going above potential. GDP was actually above potential. That's excesses. We were too much, too big, too strong, too fast. But where are we today? We're still well below potential. And it feels that way, doesn't it? Our economy hasn't reached its potential yet. And that's why we have a ways to go. We've never had a recession since World War II. There's been about 10 of them. We've never had one without being above potential GDP and excesses. We're not above excesses. This is not the suspect that has captured our bull. We can rule this one out because this tells us we've got a ways to go. This business cycle's got a ways to go, and we can just expect the bull to come back soon, hopefully, right? But there's a couple of other suspects that I want to talk about. And these three, I just want to briefly talk about, and we'll get to those in a second. But before I get to that, I have to tell you a story. Because when I see 4 of them up there, it reminds me of my 4 lovely daughters. Does anyone in the room have more daughters than me? Anyone have more kids than me? I have 4. Who has more kids than me? Anyone have 5 or more? How many do you have? 5? How many are daughters? 1. You're lucky. Any others? Yes, sir. 4? And how many kids? God bless you. Now, I tell people I have 8 kids because girls count twice. Okay? I'm just convinced of it. And some of you have heard me tell this story if you've heard me speak before. It's my favorite one. I'm telling you this story because it's my favorite one. And my twin, I have twin 18-year-old daughters that just graduated high school and they're going to college. And their names are Morgan and Taylor. And then I have a 13-year-old. Her name is Dylan. And we've shortened her name from Dylan to Dill Pickles. That's now just Pickles. So we call her Pickles. And we so like the sort of name and kind of like a food that we named our 6-year-old Olivia, we call her Olive. So we have Olive, we have Pickles, and the twins we're going to rename Carrot and Celery, have a relish tray, and we'll just go off like that. Now, so this was a while ago. This story is probably, well, let's think. Dylan is almost 14. So this is probably, I don't know, 7 years old. And at the time, we were having a problem with Pickles. Pickles wouldn't stay in her bed through the night. At somewhere between 1 and 2 o'clock, she would wake up and crawl into bed with Mom and Dad. Now, this was fine with Mom because when Mom goes to bed, she's out. But Dad, no. Once Pickles got into bed with Dad, Dad was up for the night. This didn't work for Dad. So I had to develop a plan to make sure that Pickles did not get into bed with Mom and Dad. So I did what was really the most responsible thing to do, is I set up booby traps between her bedroom and ours in the middle of the night. I put a wire across the floor so that when she would walk, she'd trip over it and fall. And it would, wake me up because she'd make a noise, and I'd put her back into bed. It's carpeted, so it's okay. Finally, she learned about that. So then I started putting like a can of soda and put like some coins in it. So when her door would open, I'd hear it. And I'd intercept her. And this was working. Dylan was staying, Pickles was staying in her bed. But I had to go on a business trip for about 7 days. And I knew without my leadership that kid would get in bed. So I went to my twins, Morgan and Taylor, carrot and celery, and I told them, it is your responsibility to make sure that Pickles does not get in bed with Mom while I'm gone. Absolutely not. So I went on my trip, and I took the red eye back. And the reason I took the red eye back is I was hoping to get back in time because one of my daughters, Morgan, was actually getting an award at school, and it was early in the morning. And so I live in Boston, and so I flew back from San Diego to Boston, got there just in time, and kind of came in the back. And she was already on stage like this, and she saw me. She sort of waved from the stage, and she got called to the podium. And she was really cute. She walked up to the podium, and she said, thank you to my teachers, and this is really great. Thank you for my parents, and all that kind of stuff. And she started to walk away. And then she made eye contact with me and then turned back to the mic. Now, this is when I knew I was in trouble. She walks back to the mic, looks at me and says, oh, and Dad, while you were out of town, Mommy didn't sleep with anyone. Okay, that's my best story. My wife slid in her seat, The other guys are looking at her like, Okay, so let's talk about the three next suspects. So we can rule out excesses. We know the excess didn't capture our bull. Our bull's still out there. So what about the next three? The first one is contagion. So what is contagion? Contagion means that some event happens that eventually takes down the entire system. This could easily be a Lehman moment. We might have seen this in 2007 where we had system-wide problems. And a lot of elements can happen with this. Currencies can happen with this, but most recently, oil. The big concern was that could a collapse in oil prices end up creating a systematic risk across the overall system that drives us into a recession and kidnaps our bull? Well, first of all, let's take a look at the price of oil. Now, the price of oil today is at $49. Do you remember how low oil got? 26. It was at 26. Now, to put that into perspective, if you went out, now we think of water as free, but that's because our government subsidizes it for us. If you had to actually buy water, actually for what it costs $55 a barrel, which is more than oil, for God's sake. In fact, milk is, $130 some a barrel? Coffee is $600 a barrel. How about these? If you want a barrel of Chanel No. 5, it would run you $250,000. Folks, Johnny Walker Special Reserve is only a bargain at $176,000 for a barrel. It puts into perspective how cheap oil still is, but where it was. Now, what we've always heard is that oil prices collapsing is good for us, right? Because if oil prices go down, gas prices go down. And if gas prices go down, then we get essentially a tax break. And gas prices went way down here, didn't they? What did they get down? What was the lowest you saw it? What? 156. Holy smokes. That's pretty low, right? In fact, if you do the math, this is how much money in the United States we spend on energy. And you can see it peaked out here at about $700 billion. We now spend somewhere in the neighborhood of 550. So in other words, we saved about $150 billion because of declining energy prices. You divide that by 150 million households in the United States, that means each household has gotten a $1,300 tax break from oil. So why are we worried about this? I mean, isn't this a good thing? Well, it's why oil prices go down is the problem. Is it because we just have too much oil? Or is it because we're not using as much? And if we're not using as much, that's a bad thing, right? That means our economy is slowing, perhaps. We're traveling less. Well, what we know is that about 70% of oil is consumed by transportation. It's gas. And what you can see is these are the number of vehicle miles we travel. We didn't travel so much during the Great Recession. We didn't pack up the kids and go to Orlando for vacation. We just prayed that we didn't lose our job. So we stayed around the house. We didn't travel so much then, but look what we're doing now. In fact, we're getting back up to sort of close to peaks. We're traveling pretty well. So it's not a demand issue. It was a supply issue. The United States energy renaissance was for real. We found all kinds of oil. In fact, we found it everywhere. I mean, I live in Boston. I believe if I took a shovel in my backyard and dug 3 feet, I'd find oil. My guess is if you went in your backyard and dug deep enough, you'd find oil too. I think, this is my personal opinion, one of the biggest fallacies is peak oil. I'm not saying we have unlimited oil in the U.S. That's not what I'm saying. I'm saying something different. We will make oil obsolete before we run out of it, is what I'm saying. I believe that we will obsolete oil before we run out of it. Here's the other part, is to think about the prices of oil. I've done this by decade. In the 40s, oil traded between $1 a barrel and $3. And you can look at all these highs and lows, and you can see it's, by and large, stayed pretty low. In fact, the lowest that it's traded, the lowest price in every decade going back to the 40s, including this one, is 27. I mean, it got down to 26 and change, but you round it up to 27. But what really is the anomaly is the high. Just lately has it gotten above 100. The bottom line is over the last 81 years, the average has been 15. Last 25 years, it's been 33. My point on this is the anomaly on oil was not that it went to 26 or 27. The anomaly is that it went to 110. See, oil should never have traded at 110, let alone anything higher than that. It didn't make sense to. We got worried because it went from 110 to 26 and dropped 80%. What we should have been more concerned about is why it went to 110 in the first place. My belief is that oil should be around 50. It's about where it is today. That's probably about fair value, because with inflation, you could sort of see this median and it probably adjusts. As you can see, it sort of grows, and we should probably be in the 50s, not the 90s, and we've reset that. But what we miss is this element of supply and demand. You see, on the supply side, we're finding oil in places we never knew it was there. Who would have thought it was in like Utah? And who would have thought it was in like Montana and Colorado and every place? Again, I think if you dug in your backyard, you might find it. But things like fracking and other things, and I'm not here to support them, I'm just reporting on them, have actually found oil in places we didn't know. But there's another element here that I believe will keep energy prices low. And it's not just because we're finding more of it, it's because we're using less of it. We will, and we are becoming more efficient. And I'm not just talking about your refrigerators, I'm not just talking about cars. I'm talking about all of that. I'm going to make a sort of a bold sort of statement. Tesla is not a car company. They didn't invent electric cars. I had an electric car when I was 10. We plugged it in. It was G.I. Joe. And like I could get in it, and it would take me like from about here to that wall, and then it'd run out of battery. But it was an electric car. Ford had electric cars. A long time ago. The problem was it couldn't go faster than like 6 miles an hour. They didn't invent the electric car. Tesla's a battery company. What they figured out a way to do is harness power in a different way. What Tesla will do that will change the world more than cars is they will help us be able to become less reliant on things like oil and other things. They're a battery company. And that's what's transformational, and this is what we're missing. I'll give you an example of this. This is the amount of money as a percentage of your wallet that you spend on energy. You go back to the 60s, you spent 8% of your paycheck on energy. 8%. Today, you spend 4. Even though oil prices have gone up, we've become so much more efficient in how we utilize it that you actually use less of it as per your income. In fact, to the tune of half. My favorite stat. If you go back to 1880, you had to work for 1 hour just to pay for enough kerosene for 4 hours of light in your lantern. Now think about that for a second. If you worked an 8-hour day, one of those hours was just to turn the lights on at night so that you can read. Today, you work 2 seconds for 4 hours of light. This is how much more efficient we have gotten at energy. And if you don't think that trend is going to continue, it is. This is the number of barrels of oil that it took to create $1 of global GDP. Remember what GDP is? That's economic growth. So to achieve $1 of global growth, back in the 70s, we needed 14 barrels of oil to do it. 14 barrels of oil to create $1 of economic growth. Today, it takes 2 barrels to create $1 of economic growth. We're more efficient. And eventually, we will become less reliant. So my prediction is not that oil is going away, not that it's good or bad. I'm not making a prediction about fracking. I'm just telling you that I believe oil will become obsolete before we run out of it. In fact, there is one commodity whose prices have gone through the roof. You know what that is? Lithium. Do you know what lithium is? It's your iPhone battery. That is the new oil. Battery. I'm not saying lithium will supplant that, but what I am saying is Tesla's working on a home battery. The problem with solar, it works great when the sun's out, but when the sun's not out, guess what? It doesn't work. You know why? Because the batteries stink. They're like my G.I. Joe electric car. They work for about 6 minutes. You can't run a washing machine on that. But if Tesla or others can put a big battery in your house that can actually hold it, now we're on to something. I'm not trying to sell you on Tesla. I'm trying to sell you on the fact that oil will at some point in time be the very cheapest thing on the planet because we don't need it anymore. And that might not happen in my lifetime or yours, but it's going to happen. And I predict it will happen in my kid's lifetime. And that'll be exciting to see. But here's the big key. Has oil or contagion captured our bull? Well, the answer is no. In fact, this is the price of oil. And what you note is that before every recession, remember all these lines coming down? Before this recession, oil went up. 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 You see a trend? Every single recession, we've not seen oil decreases. We've seen oil increases. So oil decreases ain't going to cause us a recession. We've got to be more worried about oil increases caused by excesses. This did not capture our bull. What about Janet Yellen? By the way, this is drawn accurately. Janet is about a little under 5 feet. They have progressively gotten smaller, Fed governors. Volcker was like 6'8". Greenspan was about 6 foot. Bernanke was 5'6". Yellen's 5 foot. The next one will be like 3'2" or something, right? I mean, if you're under 5, you're in a very good spot to be the next Fed governor. But here's the concern. And I would argue that this is our biggest risk. If you ask me the one thing that makes me nervous and what could potentially capture our bull someday, it's this. And it's not Janet per se, it's that Janet is in a jam. Because what happens is the Fed is responsible for 2 things. Anyone know the two things? It's called the dual mandate. What is the Fed responsible for? Any guesses? What is that? Employment and money. Price of money. Their dual mandate is to do two things, and only two things. Achieve maximum employment for the U.S. economy. And second, stable prices. They don't want deflation or inflation. Stable prices. Those are the dual mandate. The dual mandate is not to make sure the economy does well or the S&P goes up or any of that stuff. Doesn't care about that. That's not their job. Their job is hire Americans or make the conditions so that Americans get hired and make sure that prices don't go crazy. But here's the interesting part. What happens if the economy's not growing, but inflation is? Because if you think about what the Fed would do, if the economy was not doing well, what would they do? They'd stimulate the economy by what? Lowering interest rates and doing things like that, right? But what does that do for inflation? It increases it. So what happens if inflation's rising and your economy is low? What do? Do they raise rates to fight inflation? Because that's half of their job. But that would hurt the economy and employment. Or do they lower rates and keep them low to help employment, but that makes inflation go higher, and that's the other half. This is what scares Janet Yellen, and it's called stagflation. Stagflation, the flation part, is the part of like inflation that you know. Inflation, that means the prices are going up, like increasing. However, the stag means a stagnant economy. Stagflation means the economy ain't going anywhere, and inflation is, and it puts Janet in a bad spot because she has to make a decision. Which one does she help? She help the economy and make the inflation worse? Does she battle inflation and make the economy worse? She can't do both. And this is the real fear. The fear is that our economic growth will stay low and inflation will go higher, and we're starting to see it. Now, I know what you're saying. Gas prices are down. In fact, even food prices are down. I don't know if you know this, but hot dog prices are down year over year $3. Tomatoes are down 35%. I have no idea why. Butter's down. Even cookies and milk, for God's sake, are down. But outside of food and energy, everything's up. Shelter's up. Rent's up. Utility prices are up. Medical care's up. Education's up. Concerts are up. Even going to see the Lions play football, those prices are up. Those are up almost 8%. Prices are going way up. And let's face it, we spend a lot of money on butter and cookies, but we spend a whole lot more on the stuff at the top. Inflation's on the rise. In fact, if you look at some of the key economic measures, they're still not bad. Our economy was growing at about a 3% clip. Right now, we're growing at more of a 1.9 clip. So this has actually come down a little bit. It's not terrible. It's just not great. But inflation's moving higher. Inflation has gone up from 1.7 to 2.3. Doesn't sound like a lot, but it's quite a bit. And same with wage growth. Wage growth is the one thing we got to watch the closest. Because as you make more money, what do you do with it? You spend it. And as you begin to spend more of it, what does that do to prices? It makes it go up. And as it goes up, companies go, oh, we're making more money, so let's hire more people. And then what do? They hire more people, which means you have more money. And then it's a vicious cycle, and it keeps it going higher. This is what Janet is watching. Prices going up. The economy, teetering. Not bad, just not great. You want to know what the Fed's going to do? All you got to do is follow wages. The white line is wage growth. You can see it goes up and down. It typically peaks right before recessions, peaks before recession, peak before recession. Those are the excesses. It then falls after recession. We don't get raises during recessions. It falls, it falls, it falls. And the red line is what the interest rates do. And you can see the Fed watches it pretty closely, and look what's happened here lately. Oh, an uptick in wage growth. We've been getting raises here lately, tune of about 2.5%. Doesn't sound like a lot. I wish my raises were bigger. That being said, it's still more than core inflation, and it's on the rise. And this is that little blip of interest rates that we saw, that one little boop. It's got a long way to go. Where do you think interest rates are headed? They're moving higher. But what it requires is that our economy does better. This is the biggest risk, I think, is a mistake by the Fed. The Fed raises rates too soon. And this is really some of the concern we've seen lately. The market's been worried over the last year that the Fed will make a policy mistake. Why hasn't the market moved higher in the last year? It's because the Fed raised rates in December and the market didn't love it. And we sold off at the beginning of the year. And they thought that we were going to raise rates again in June. And the market had to tell them, please don't do it, by putting some volatility here lately. So what's going to happen is rates are moving higher and they need to move higher. And we shouldn't be worried about them moving higher. Because what the market has wrong is we don't need to be on the Fed life support anymore. And more importantly, what the Fed misses, they know this, but what they need to understand more, and the market needs to understand more, is that having low interest rates over a long term hurts us more than it helps us. We as Americans, we receive 5 times more interest than we pay. Bank accounts, what is your interest in that? 0. Savings accounts, nothing. Bonds, zip. CDs, nothing. All those are low. Those are things we rely on. We receive 5 times more interest than we pay. It's great that we got to refinance our homes. That's awesome. We already did that. Raise them so we can get some more interest in our accounts. We will benefit from the Fed raising rates. Slowly and deliberately, we think the Fed will and will allow the bull to continue. We don't think the Fed will ultimately, or Janet and this stagflation, will take our bull. We believe the bull will continue to move after this. And the last one is Brexit. Who knows what Brexit stands for? What's the BR? Britain. And exit means they're going to exit what? Yeah, the EU. They've been a part of the EU since the beginning, and now they're voting when? Tomorrow. Tomorrow. To decide whether or not they're going to stay in the European Union or not. And this has got the markets like freaked out. So why? Well, before I get to that, I got to tell story number 2. Sorry, Craig. My apologies. Because when I see Britain, I think of my second favorite story, because they drink a lot of tea, and this is my tea story. I like hockey. Anyone like hockey up here? You got a pretty darn good hockey program. I'm from Boston. We do too. One of the originals, like you. We've also won a Stanley Cup more recently. But it's been a while still. Okay, so it was Stanley Cup playoffs. And my wife decided to do something extremely irresponsible during the middle of hockey playoffs, and that is to have a ladies' weekend and leave the 4 kids with Dad. So I did what any responsible father would do. I took them to Target, gave them $50 each, and said, buy something that will keep you out of my hair for the next 3.5 hours. The kids, the twins, bought a video game. Pickles went and bought something. And Olivia bought a tea set that looked like this. She came back, and the twins went to do their video game, and Pickles went to do her thing. And Olivia took the tea set into the playroom, which was right beside the family room, and she was having a tea party with all of her dolls. And it was perfect because she was right there. And then like every so often, she would actually come and actually bring me like some water in the tea, and I would just take a sip because I was cheering for my team, and I get a little parched. And so I needed a little sip of tea, and I would take the tea, and I got to check on her, so that's the responsible part. And then she'd run back off, and 10 minutes later, she'd come back. It was perfect. Perfect. In the second period, Taylor came down. That's carrot or celery, one of the two. And when the twins came down, she started sitting down. And right on cue, here comes Olivia with my next tea. I take the sip of tea. She goes back off. I'm watching the game, and Taylor says, Dad, where's she getting the water? Now, I hadn't contemplated this. I started going through the map and geography of the house. I'm realizing that down this hall, there's only 2 rooms. Bathroom, playroom. So I say confidently to Taylor, the sink, of which she rebuts, she's too short to reach it. Right on cue. Here comes Olivia with my next tea. I freeze her in her tracks. Olivia Marie, have you been giving Daddy potty water? She just breaks down, crying. Waterfalls. I broke her heart. I broke her heart. Now understand, the twins, they're 18. They don't want anything to do with Dad. Pickles, she's 13. Nothing to do with Dad. Olivia's all I got. My wife hates me. And I broke her heart. She comes over and hugs me, and I feel all confident. Look at Taylor, and I'm like, see, it wasn't potty water. She gets up to leave. I'm waiting for my next one because I'm confident. She turns around and says, Daddy, I would never give you potty water. Got it out of the doggy dish. Okay. All right, Brexit. Brexit is abbreviation for British exit. What happens if they stay? What's that called? Oh, Bremain. Okay? So it's either Brexit or Bremain. Now, I'm not exactly sure what they're going to do because polling, I'll show you that in a second, is basically 50-50. And the vote's tomorrow, but we'll talk a little bit about why. What the market's most concerned about is not the fact that this is going to break up the European Union or all kinds of issues are going to happen. What it really is uncertainty, and the market just hates uncertainty. It just doesn't like it. Now, why isn't it good for the UK? Well, it certainly destabilizes 2 decades of peace with Northern Ireland, plus Scotland almost voted to get out of a relationship with England. The reason they stayed? Because they're part of the EU. That wouldn't be good. And in addition to that, look at this. EU takes 50% of what UK produces. They're their biggest trading partner. And what happens if they're out? All those trading contracts and all that stuff is gone. They got to reestablish them. There's going to be new tariffs. It's going to be more expensive potentially. The EU, it's not good for them. They lose the 5th largest economy in the world and certainly a big chunk of their defense and other things. The bottom line is, I don't know how this is going to break. You tell me. Bremain ends up to be red, is white. Leave ends up, or Brexit ends up to be red. It looks pretty even, and this is who's going to decide it, and those are the undecideds. A big chunk, almost 15%, are undecided, and ultimately they're the ones that will decide. Now, we've seen this before. Entering into the Scottish referendum, it was about even, and we know about 80% of the undecideds went with the status quo. Typically, about 3 out of 4 of undecideds break for the status quo. And if that happens here, it will remain and not Brexit. But I'd have no earthly idea what's going to happen. That being said, I believe ultimately this will end up being another blip. Because this doesn't bring down the 5th largest economy in England. It just changes the way that they have a relationship. It certainly doesn't change the fact that Europe's economy will still be strong. There's got to be things that need to be done. New tariffs that's got to be put in place, and that's going to be a lot to figure out. But what I don't think will happen is that this will be the speed bump that ultimately slows down and gets rid of the bull market. We believe that that will not end it. The reality is that these usual suspects, well, they're probably not going to end. And we believe that this guy, the bull, will come back. We think this bull market's not over. We think it's been on pause for the last, say, year and a half. But we believe that we've got a little bit more in this bull market. And we got a ways to go. In fact, right now we are the 2nd longest bull market that we've ever seen. That probably will tell you, well, isn't that bad? But remember that bull markets don't die of old age. We die of old age, but bull markets don't. I showed you what they die of. They die of excesses. And we don't have any excesses today. We're not overbuying. We're not overspending. We're not overhiring. We're not over anything. And without excesses, bull markets don't end. In addition, this bull market's been different. In fact, other bull markets like this one was a lot shorter, but a lot higher. This bull market a lot higher, and this one both longer and higher. If you link by how strong the bull market has been, this is only the 5th strongest, but 2nd longest, which tells you it hasn't reached its potential yet. and could have a ways to go. So one of my favorite charts is this one. Because sometimes you go through a period like this where the market doesn't move in a year and a half and you think, gosh, what am I doing investing? The reality is, this is the chart I always remind people. All I'm really showing you is what stocks do. And I'm going back to 1980. Any of the bars that go up means a year that stocks went up. Any of the bars that go down is a year that stocks go down. What do you notice? There's a whole lot more up than down. Like a lot more. In fact, if you ask me what the market's going to do, I will tell you with 74% confidence that the market will go up. Why? Because 74% of the time the market does go up. And the reality is, we do have periods of time where either the market is low or very flat. They happen sometimes for a couple of years. But the good news is, we've never seen a 20-year period that was down or flat. We know what markets do over time. And it helps us remember the really important things of investing. It's the long term, not the short term that matters. It doesn't matter what happens over a year or 2, 3, or 4, or 5. It's the longer term investing that really matters. Staying with a plan is important. Because every single time you've seen these negatives, they haven't lasted very long. And these are usually the time we abandon our plan. Don't abandon your plan. Don't give up on investing. Don't give up on diversification or asset allocation. This is the time to double down on it. Let me take that back. Compliance would like me to say that. I'm not saying double down. I'm saying this is a time to stay committed to it. Committed. It's a time to stay committed to your plan. But we think the market potentially has some tailwinds that are coming. Remember I told you about a couple of the headwinds. The first one was the dollar and the second one was energy prices. This over here is energy prices, and you know that year over year the energy prices was negative, but look what's happening. Pretty soon here now, energy prices are going to start to be, actually this is energy, my apologies, this is energy. Dollar, energy, sorry, energy prices, dollar. The reality is that what's happening is both energy prices and the dollar are beginning to go from being a headwind to a tailwind. The dollar, the strong dollar, hurts corporate earnings. But now we're starting to see the dollar begin to moderate, and that's good for corporate earnings. We know that energy prices have plummeted, and they've come back a little bit, but they're still way lower than what they were. But the reality is that has hurt the earnings of energy companies. And those energy companies aren't buying Caterpillar tractors and other elements that hurt other places of our economy. So the reality is if we can get energy prices to stabilize and the dollar to stabilize, earnings will stabilize. See, we've had negative earnings here for 4 quarters in a row, but we're poised to get positive earnings here very shortly. And we're excited about that. Secondly, that will be good for stocks. Second thing that I would note is that we are used to having a slow start when it comes to economic growth. I don't know why this is, but this is the economic growth in the first quarter. Notice how weak they've always been. In 2009, it was negative. It was weak in 2010, 11, 13, 14, 15, and this year. But look at the comeback in the rest of the year. We came back strong, came back strong, came back strong, strong. What do you think might happen this time? We expect a strong second half. First quarters have been really weak here recently. Some of it's weather related, some of it has been economic growth, some of it has been the dollar. But the reality is the rest of the year has been pretty good. And while the first quarter only grew at about 1%, the second quarter's on pace so far for 2.5%. And maybe we might get 2.5 to 3 in the second half. And if we can get 2.5 to 3% growth in the second half, that bodes very well for our economy and certainly for earnings for companies and therefore prices for stocks. Our forecast is that stocks will end the year somewhere in the mid-single digits. That's about 5 or 6% per year. Lots of volatility. We're going to see some ups and downs, but we believe the market will be higher at the end of the year than it is today. What about elections? Everyone wants to ask me about elections. Well, if you want to know who the market, well, let me just first show you the chart. So this is the average of every year 4 of a presidential election. The yellow line it takes out 2008, because 2008 had the Great Recession in it and certainly skewed the numbers a lot. The white line includes the Great Recession. And what you note is this. The start of the year, well, we don't go very far. In fact, it's pretty volatile. And you can see what's happened this year. We had a big sell-off, and now we're back kind of to even. And we're right back in line with normal. And typically, things are pretty flat until we know about who's going to win. And then once we know who's going to win, the market begins to move higher. It doesn't like uncertainty. And once it begins to know who's going to win and price those in, the market typically rallies in the second half, which is another tailwind potentially for this market. So who does the market want and who does it think it will win? Well, let me first say is the market doesn't care. What most people think is that who is president impacts the economic cycle. It's actually the reverse. The economic cycle determines who's president. Because if the economic cycle says that we're in a recession and things stink, guess what? Incumbents don't win. If this economy was awful, there's no way that Hillary Clinton would have a chance. Because this country would say, we don't want that. Now the question is this economic cycle saying the economy is good or bad right now? It's a toss-up. Now, if you want to know the one single best determinant of who will win, and this has worked in every single election except for one, and that was the last one. The last one predicted that Romney, using this one, would have won by 8 points. And he lost by about that many. And that is this. If you look at the year over year, after tax, after inflation, amount of your paycheck growth. And if it's above 3%, the incumbent wins. If it's below 3%, the incumbent loses. And that's worked every single election, except for last time. Because last time, economic growth wasn't so great, wage growth wasn't so great, and Obama still won. So it's the one exception to the rule. So what does it say today? It says that Hillary will win, because wage growth is pretty good. I have no earthly idea who will win. I don't really care who wins, because I'm not a political person and my job is to make money regardless of whether or not whoever the president is, Democrat or Republican. But the reality is this. The market typically doesn't care. But what the market doesn't like is uncertainty. And I think the one thing, this is just my personal opinion, is the one thing that the market is unsure of is what it will get from Donald Trump. I believe that that's the one thing the market just doesn't know. Not exactly sure, because it just doesn't have enough sample sizes to what Donald will be. That's not the value statement of good or bad, it just is unknown. We've got a long, long, long history of knowing what the market knows what Hillary will be. Whether you like Hillary or not, the market at least knows what Hillary will be. So there's not a lot of uncertainty with Hillary. There's more with Donald. So my personal opinion is the market will probably be will react less well if Donald begins to poll higher in the polls, largely not because of him, but just because of uncertainty and familiarity. Only because of that. But ultimately, whoever wins, the market doesn't care. Because ultimately, the president doesn't define the market. The market defines the president. So our view is that the bull continues. The bull continues regardless of who is going to be president. The bull will continue regardless of whether or not we have Brexit or Remain. The bull has been in hiding because of a lack of confidence. And I believe confidence will begin to come. Once we know who the next president is and we get to know him or her, we will become more confident. And I believe corporations will become more confident once we start to see the Fed begin to raise rates in a responsible way. And all those things will allow the bull market to continue over the next year or so. Let me end with this. If you Google the word recession, you will see that it bounces around a lot, and it's up a little bit. But let me just put this into perspective. If you compare this red line with Googling of the word Donald Trump, it's just a little different. A lot more people, in other words, are interested in Googling Donald Trump, whether you like him or not, than are worried about looking at a recession. Here's the one thing I'll say. Again, I'm not a political person at all. But I'll make two things. I love this line. Every minute of you're angry, you lose 60 seconds of happiness. Here's what I'll say. I don't think we're a real happy country right now. And one of the things I pray is that we begin to find happiness. I make two things if I can talk to voters and if I could talk to our candidates. I would say two things. Here's what I'd say to voters. I pray that we get to a point where we vote for someone, not against someone. It seems like in this particular election, we feel a lot stronger about who we don't want to vote for than who we do. And what I hope we find as a nation is who we want to support, not who we don't want to support. Because it's always better to vote for something and fight for something than a fight against it. What I would say to the politicians is this. The words that have hurt me the most were said by me, not to me. And we're saying some pretty mean things right now. And I hope that that rhetoric begins to slow down. Okay? Let me end with this. This is my Olivia. She'll be 7. She has no more teeth. She had an assignment. And the assignment was every one of the kids got 5 animals. And they were studying defense mechanisms. What do animals do when they're under stress? And each kid got a different one. One kid got like a camel and a ladybug and a frog. And the other one got like a whale and a dog and, a horse. And Olivia got her 5. And we worked on this over Christmas. And she had to draw it and write, what do they do when they're stressed out, when they're in danger? And so her first one was a lion, that's a pretty good drawing. And a lion goes, grrr, roar, roar, right? That's what it does. It roars at you. The next 3 was a jellyfish, a bird, and a turtle. And what she wrote was when stressed, the jellyfish stings everyone. And the bird, well, it just flies away. And the turtle hides in its shell. It just hides when it's stressed. The very last animal she had to draw was the butterfly. And this one stumped her. What does the butterfly do when it's in danger? What does the butterfly do when it's stressed? We know what the lion does. It roars at people. And we know the jellyfish just stings you. And we know the turtle, it just hides. But what does this one do? This one sat for days over break. I couldn't wait to see what she'd write down. And then she wrote this. Be beautiful. And then that hit me. We get to choose when we're under stress. And we could scream and yell and growl like the lion. We could hurt people like the jellyfish. We can run and hide. Or we can choose to be beautiful. I pray we choose to be beautiful. Thanks for having me.
Thank you very much. So on behalf of your advisor, thank you for taking the time to come, and drive safe on your way home. Thank you.